All right, so Trump finally made his long anticipated tariff announcement on April 2nd, what he's calling Liberation Day. And I will say it was substantially more aggressive than I think most people were expecting. And the stock market and bond market have reacted accordingly. The US stock market is down 3.5–4% today, which actually isn't near as bad as it could be, which tells me maybe the market doesn't really believe that this is going to be a long-term strategy. So let's walk through what happened. I'll mention my theory on what I think is going on here, and then more importantly, what it could mean for your personal finances. So the big announcement was the introduction of US reciprocal tariffs, or as he called them, discounted reciprocal tariffs, with a minimum 10% tariff applied to all countries, so all imports into the US. Here's a chart detailing the tariffs that each country will now face, with a particular focus on those that, in Trump's words, treat us badly. Here's how he explained that first column. We will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we're being very kind, we will charge them approximately half of what they have been charging us. So the tariffs will not be a full reciprocal. Now, those numbers there in the administration's chart aren't the actual tariffs those countries impose on us. That's not what they're actually charging us. Here's a chart that Reuters put out on the average tariff rates of the US and its top 15 trading partners. This data is from the World Trade Organization using 2024 trade data. So this chart shows the simple average, which just averages all tariff rates equally, and then the trade-weighted average, which gives more weight to goods that we import more of. So these numbers are vastly different than the chart that the administration showed. So what numbers are they using? Well, it's been discovered, and I don't think this has been confirmed by the White House, that these are not tariffs at all. They're the U.S. trade deficit with a country divided by the exports to that country. So in other words, it's the trade imbalance ratio. So let's take Vietnam, for example. The simple average tariff is 9.4%, according to the World Trade Organization. The trade-weighted average is 5.1%. In Trump's chart, that number is 90%. So that 90% figure reflects our trade deficit with Vietnam as a percentage of our exports to them. So it's not really a reciprocal tariff at all. Some countries with little to no tariffs on the U.S. will now be subject to this so-called tariff. It's really a trade imbalance penalty. So why do it this way? Well, if you've been following along, you know that Trump has long argued that trade deficits are evidence of other countries taking advantage of us. So Trump sees trade deficits as a direct drain on American wealth. His logic is that if a country sells us $100 billion in goods, but is only buying $20 billion in goods from us, then they're robbing us or ripping us off. So a high tariff is a way to penalize that imbalance. So by linking tariffs to the trade imbalance, the strategy, I believe, is to pressure countries to either import more U.S. goods or reduce their exports, or you face these steep tariffs or penalties. So in effect, it caps imports from countries with high trade deficits, which would ideally encourage domestic production, which has been a core goal of his economic agenda. Now, of course, that approach comes with risks. Number one, reciprocal tariffs from other countries. And number two, what I think a lot of people are worried about is higher prices for consumers. It's actually the U.S. company who pays the tariff. And those tariffs are at least partially paid, if not largely paid, by the end consumer, so the U.S. consumer. Now, how foreign suppliers and governments respond, is going to vary. There's this challenging tension in the way that this policy has been framed. It's framed as that tariffs will both increase revenue and bring back manufacturing. So Trump has suggested that this new tariff revenue will allow us to lower income taxes while simultaneously boosting domestic job growth. But those goals sort of contradict each other, because if tariffs succeed at reducing imports and bringing back manufacturing to the U.S., then the tariff revenue will fall because there's less tax, because there's less imports. On the other hand, if tariff revenue remains high, that means that imports are continuing and that the manufacturing boom here in the U.S. hasn't materialized. So I'm not sure what the hopeful outcome is here. It really has to be one or the other. You also run the risk of, let's just say that these tariffs remain in place for the next several years. And as a result, companies start to invest billions of dollars back into manufacturing here, as is one of the stated goals, and as some companies have already started to do. Well, what happens when the next administration, or whoever it may be, is more of a proponent of free trade, and that those tariffs get reduced or eliminated entirely? Suddenly, foreign producers regain a cost advantage. And that undermines all the investments that took place in the US for manufacturing here and the job growth here. I don't think that's an unrealistic possibility. Trump's aggressive tariff policy is not necessarily mainstream, even within his own party. And so I think a future shift back to free trade or more free trade is very possible. So that's a risk as well. And then there's the possibility that this is just a strategy that is intended to only be used for a limited amount of time to accomplish an objective or a set of objectives. I think that's very possible as well, and probably plays a big role. Now, here's my theory, and it's just a theory, so take it with a grain of salt. Unlike income tax changes, which require congressional approval, tariffs can be imposed through executive action. Remember, Trump wants to pass a tax bill before the end of the year, but doing so under current budget rules require either $2 trillion spending cuts or new revenue. So one way to show new revenue that Trump actually has somewhat control over is tariffs. So if the administration can project higher tariff revenue, they might use that to justify and push through major tax cuts without massive spending reductions. And then once the tax bill passes, Trump could scale back the tariffs. Now, Congress may be skeptical of relying on uncertain tariff revenue, but it's plausible that this is part of the strategy. I don't know. It's just a thought. Now, let's move on to what really matters, and that is, how does this impact you personally? I'll start with the prices, and then I want to get into the investments or the stock market. So first and foremost, I would plan for higher prices, at least in the short term. Even before tariffs go into effect, companies are likely to raise prices in anticipation. I believe the 10% baseline tariff is in effect now. That went into effect immediately, where everything above that for the worst offenders goes into effect April 9th. So I would review your monthly cash flow, consider factoring in a 10 to 15% increase in expenses. It's not a precise number. It's going to vary by household, but I think it's wise to be proactive with that. You may also want to reassess your emergency fund. As living expenses rise, so does the amount that you're going to need on hand in case of a job loss, a car repair, or a medical bill. Hiring may slow down or even reverse, so I think it's worth building in some extra cushion with your cash. Now let's move on to the investments. And of course, this is not investment advice. These are just my thoughts. The market is reacting to the unexpected exactly as we would expect. Stock market is down, bond yields are down. I'm personally not making any sudden moves, and I'm not advising my clients make any sudden moves either. I know that every day feels unprecedented, but that's always true. Every day, every moment is unique in history, and yet over the past 100 years, the market continues to grow. Despite all the noise, we're actually still very close in the grand scheme of things to our recent all-time high from earlier this year. And while these events feel significant and chaotic while we're in them, from a long-term investment perspective, I think it rarely justifies a change in strategy. Unless you're extremely concentrated, then you may want to consider a more diverse approach, but that's up to you. Over the last century, markets have survived wars, recessions, pandemics, policy upheavals, and they still remain one of the best long-term tools for wealth building and inflation protection. This is also a good reminder on why global diversification matters, and I'll be doing a full video on that soon. But a limited concentration in any one industry or country is usually a good thing, especially in times like this. It's also important to note that downturns are often followed by rapid and unexpected recoveries. Remember, back in March of 2020, the world shut down, markets were crashing, and then April was one of the best months in stock market history. If you had sold at the end of March, just waiting for clarity, you'd have missed the majority of the rebound. Same thing happened in 2009, just months after the 2008 crash. Selling during a downturn and waiting for things to feel better usually results in missing the rebound, because the market typically turns before things feel better. So while things feel rough right now, and they may stay rough for a while, if your portfolio matches your risk tolerance and your timeline, your goals, the key is really just to stay patient. Morgan Housel has a quote, the author of Psychology of Money, great book, said that volatility is the price of admission. That's what you have to pay. Sticking with it during the ups and downs is the price you have to pay to get those good long-term returns. So stay the course. If you're in the accumulation phase of life, this is actually a great opportunity to buy at a discount. You just keep dollar cost averaging, keep buying every week or month as usual, and I think you'll thank yourself down the road.